All right, welcome back. Today, we're diving into a company you've probably driven past 1,000 times, but maybe never really thought about, Murphy USA. From an investor's point of view, it's this really fascinating puzzle of efficiency, risk, and a race to transform. So, let's get right into it.
So let me start with something that sounds totally backwards, but it is the absolute key to this whole story. Most gas stations, they don't actually make their money selling gas. Yeah, you heard that right. In fact, a lot of them sell it at a razor-thin margin, sometimes even at a loss. And if you can wrap your head around that paradox, you'll unlock the entire investment thesis for Murphy USA.
Okay, so if the money isn't at the pump, where is it? Well, that brings us to our first section here, the unlikely profit machine. To really size up Murphy as an investment, you first have to understand the weird, kind of counterintuitive economics of how a gas station actually stays in business.
Now, if you just look at their revenue, you'd think, oh, okay, Murphy USA is basically a gas company. And I mean, it makes sense, right? Almost 80% of all their money coming in, their revenue, is from fuel. It's a huge number. But revenue is only half the story.
And here's the other half. When you look at where the profit comes from, not just from Murphy, but across the whole convenience store industry, the picture completely flips on its head. Over 60% of the actual profit comes from the stuff inside the store. The sodas, the snacks, the coffee. The cheap gas isn't the product, it's the magnet. It's the thing that gets you to pull over, get out of your car, and walk inside.
And this leads to a really important concept they use called fuel break-even. It's kind of their secret sauce. Because the profits from all that in-store stuff covers so many of their costs, they can afford to make next to nothing on their gasoline. And what does that let them do? Offer some of the lowest prices at the pump, which pulls in more cars, which sells more merchandise. You see? It's this brilliant, self-reinforcing cycle. Now, that whole super efficient business model is really built on one single, massive relationship. And that brings us to our next section, the Walmart double-edged sword. Because this partnership is, without a doubt, both Murphy's greatest strength and its single biggest risk.
The entire tension of this business is laid out right here. On the one hand, it's this incredible symbiotic relationship. I mean, think about it. They set up shop in Walmart parking lots, giving them this constant fire hose of customers without spending a dime on marketing. But the flip side of that coin is this huge concentration risk. Murphy's fate is just so deeply tied to Walmart. Any little change in Walmart's strategy or even a dip in their foot traffic could be a massive blow. For an investor, this is the balancing act you have to weigh constantly.
All right, so that leads us to the biggest threat coming from outside the company. Section 3, pivoting beyond the pump. The truth is, Murphy USA is in a race against the future. And believe me, they know it.
You know, the elephant in the room for any company that sells gasoline is, of course, the rise of electric vehicles. And this isn't some short-term problem. It's a huge, long-term tidal wave that threatens the very core of their business. The demand for gasoline will shrink over time. So the big question for them is, can they transform their business and find new profits before it's too late?
And to really see the challenge they're up against, just look at this chart. Compare their merchandise margin to a competitor like Casey's, which is famous for its in-store food, like pizza. Casey's margin is more than double Murphy's. That gap is what Murphy is desperately trying to close. They have to shift from selling just low-margin cigarettes and soda to high-margin stuff like fresh food and coffee.
So what's the game plan? Well, here it is. First, they made a really smart acquisition back in 2021, buying a company called QuickCheck to basically get a crash course in running a great food service operation. At the same time, they're modernizing their own stores, getting rid of those tiny little kiosks. The end goal here is to become a real convenience destination, not just a place to get gas. It's a defensive move to make the business way more resilient as gas demand eventually fades.
And one of the coolest things they're doing is this raise and rebuild program. It's so simple, it's genius. They find their best performing locations, the ones with all that great Walmart traffic. They tear down the old, tiny kiosk, and they build a brand new, modern convenience store right on the same spot. It's a really smart, efficient way to upgrade their best real estate and start capturing those all-important, high-margin sales.
So with this incredibly efficient model, they generate a ton of cash. What do they do with it? Well, that brings us to Section 4. And frankly, what might be the most compelling part of this whole story for an investor, the shareholder's secret weapon.
Just look at this number for a second. Negative 50%. Since Murphy USA became its own public company back in 2013, they have bought back and literally erased half of all their shares. Just let that sink in. A 50% reduction in the share count means that if you own a share today, your piece of the company is twice as big as it was. This is an unbelievably powerful way to create value for shareholders.
And make no mistake, this isn't some accident or something they just do with leftover cash. As this analysis says, the buyback program is a central pillar of their entire strategy. Management is sending a very clear signal here. Our plan is to return capital to our shareholders, period.
I mean, the numbers here just speak for themselves. Year after year, they spend a staggering amount of money buying back their own stock. Just look at 2022. They spent more than double on buybacks what they spent on building and upgrading stores. That tells you everything you need to know about where their priorities are. This is a management team that is absolutely laser-focused on shareholder returns.
Okay, let's pull all these threads together. This brings us to our final section, the investor's final question. This is really where we have to weigh the good against the bad and frame the decision you'd have to make as a potential investor in this company.
So here it is, the whole MUSA balancing act. The bull case, the argument for owning it, is pretty clear. You've got this great low-cost model piggybacking on Walmart, it spits out tons of free cash, and management aggressively gives that cash back to you through buybacks. But the bear case is just as strong. You've got a scary dependence on Walmart, you have to deal with volatile fuel prices, you have the long-term threat of EVs, and there's always the risk that this big pivot into food just doesn't work out.
And that leaves us with the ultimate question you have to answer for yourself as an investor. Is Murphy USA a brilliantly efficient cash machine that's making all the right moves to transform for the future? Or is it just a melting ice cube in a desperate race against time? The answer to that question is everything.